Now we're going to talk about discounting future cash flows to the present value. So that is what we would pay today for the amount of money in the future. So when we're looking at present value, it's called discounting. So we're discounting money back at a specific rate of return. So what we need to know is what the estimated future cash flows are, the amount of time that we're looking at, and the required rate of return we want on any investment. The time value of money follows the concept that a dollar received today is worth more than a dollar to be received in the future. And the reason for this is because money earns interest over time. Two methods that we look at for capital investment analysis that follow the time value of money are looking at the net present value of that investment and the internal rate of return on the investment. So when we look at the time value of money, we need to know a certain amount of things. One is, what is the amount of money? Is it a lump sum? Is it an annuity? An annuity happens every year in a consistent fashion. What is the length of time? Is it a 5-year investment? Is it a 10-year investment? And what is the interest rate? In this interest rate amount, this is the annual percentage that we earn on the investment. That interest rate is also called the discount rate, or the hurdle rate, or the required rate of return on an investment. We look at present value and future value tables. So what we're going to be looking at for these investment decisions are the present value tables. We either look at a present value of one or the present value of an ordinary annuity. And I'm going to show you how to look up information on those present value tables. So the net present value is the difference between the present value of the cash flows and our investment's total cost. I already said the discount rate. We also call that a hurdle rate. That's our desired rate of return on a capital investment. That's shown as a percentage rate or an interest rate. You have present value tables in your textbooks. There are examples on the slides. You can also look up present value online, or there are present value calculators. So when we're looking at this present value table, we have the present value of a dollar. So we have the number of time periods, what our discount rate is, and then when we match those up on the slide, so if we look at 10% for 5 years, we get what's called a factor. That factor is what we take our amount times in order to discount the future value back to what its present value would be today if we were looking at an investment rate percentage of that amount of money. The present value of an annuity is used when we have consistent amounts over specific time periods. So this means if we have an annual cash flows, estimated annual cash flows of an investment of $10,000 a year for a 5-year project, then we would have 5 periods of equal payments. We would go to whatever rate we want for our required return and pick a factor to discount that investment back to its present value. This discount rate, as I've said, is the investor's required rate of return. We want our investment's future cash flows to be higher than the outflows of money. If we have a positive net present value, then we know that that investment is going to make money for us. However, if the net present value is below 0, we know that that investment is a losing proposition and we'll never recoup our money on that investment. So we're going to look at this example. We're back to the baseball team that we've been talking about for the entire chapter. They have a required rate of return of 15%. They're looking at these 10 vending machines. They're expecting net cash inflows of $24,000 a year for 5 years. If you look up the present value, you find that the discount rate at 15% is 3.352. If we take 24,000 times 3.352, we end up with a net present value of $80,448. Well, if we remember back to previous slides, that initial investment was $75,000. So if we take $80,448 minus $75,000, we have a positive number. So we know that not only does this investment cover our required 15% rate of return, but we're also going to recoup our money on the investment. So that gives us that net present value of $7,933. We also are going to do the net present value of any salvage value that we're going to receive, as you can see in this slide. As I said before, if the net present value is equal to or greater than 0, then we know that the investment is going to generate our minimum required rate of return and we can accept that investment. If we have a negative net present value, we're not going to recoup our money on that investment. It does not meet our minimum required rate of return and we should reject the investment. This is just a slide that gives you a table of whether to accept or reject decisions when we're looking at net present value calculations. So this company also needs to think about non-financial issues. So other things that they're thinking about are maybe they're not the best company to go with for vending machines. We've only gotten that one bid and maybe there are other arrangements. Or maybe we could have a catering service serve fresh food. Maybe we're not interested in serving vending machine food. We also have other different investment opportunities. We had the one at the beginning of the slides where we were looking at maybe we're going to buy a new bus. We can also invest in various equipment, new uniforms. We can upgrade our stadium. There are a lot of things that we could do with that $75,000 investment that could potentially benefit the team that aren't about serving money or serving food during games. Now we're going to look at a net present value example. This example has even cash flows. So when we have even cash flows, that's an easier amount to calculate. So we're going to look at the present value of an 8-year useful life. We have 0 salvage value. We have a $16,000 piece of equipment, 12% annual return on our investments, and it's $4,100. So when we're looking for the net present value, what we want to go to the net present value table and look for the present value of an ordinary annuity. So this is when we have equal payments. We can look at an ordinary annuity. So we have an 8-year project at a 12% rate. So we need 8 years at 12%. And this is just a present value table site that I pulled up online. So we have 12% times 8. Our factor is 4.96764. So the first thing we're going to do is take our 4,100, that's our annual amount, and then our factor, as we can see here, 8 at 12 years is 4.96764. 96764. So we take our annual cash flow times the factor. That gives us $20,367.32. Our initial investment in that piece of equipment was $16,000. So if we add those two numbers together, that gives us a net present value of $4,367. It's a positive net present value, so that tells us that this investment meets our required 12% annual rate of return, and we're going to recoup our $16,000 investment plus additional money. That way, the annual, where we take the annual cash flows times one factor, that works for equal cash flows. We'll look at what happens when we have unequal cash flows in the next